Today is April 17, 3:41 p.m. We saw some unusual options on AMD, and we're going to go over that and then propose a different trade instead of these unusual options because it takes less buying power than the one we saw. So briefly, before we get right into it, you could see that we are at a DeMarc's 9 indicator, which means a trend reversal is possibly going to happen soon. And also we are at the oversold conditions on the William percent R indicator. You see back here when there was a 9, also the trend reversed towards the downside. This is the red line is the $100 mark, a strong resistance for AMD. And so now without further ado, let's get right into the unusual options we saw. So at 122, you see here these 5,000 contracts. All right. And you see one of them is a April 21 at the 90 strike puts. And then you have these May 5, 86 strike puts and the 76 strike puts. So the one that's coming up on April 21, let's take a look at that one first, and you'll see here that this is the one. We believe that this one was sold. These 90 puts were sold, and whether or not they were closing the order by selling it or opening it, it doesn't really matter. Because right now the volume and the open interest are about similar. So it could be a closing or opening. And the fact that if this was an opening order, if they sold it to open, then it would be bullish. If they sold it to close it, then they would be just taking profits. But the question then to ask is, why did they take profits now when it could possibly be more profitable? If they felt like it was bearish, they could have just left this 90 strike on and continued to profit as it became deeper out of the money or in the money. That is, so that they can collect and sell it 4 days later for greater profits, right? So that's why we think this is a sell. And that's why we also did a position that is selling this. And we also bought the 88 puts. This reduces the buying power. Otherwise, to sell these 90 strike puts, that's like saying you're willing to own 100 shares of them, right? So that requires 9,000 for one contract to sell those 90 strike puts. And since they did 5,000 of them, that's a 45 million buying power trade here. So we reduce this by just if you were to sell the 90 and then buy the 80, that's only 200 buying power because it's a difference of 2. All right. And so then after this trader sold that 90, they went to the May 5s and then they bought the 86 strike puts and sold the 76 strike puts. Right? You'll see here the volume is 5,000 here at the 86 and also that 5,000 at the 76. These are all opening orders because they're greater than the open interest. Okay? And so what this trade then looks like, these 5,000 unusual options, it looks like a bullish trade. It will profit as the price moves from 89.6 upward. And if it does continue to drop, there is a hedge here where there is a limited downside. The risk is reduced. The loss is reduced here because they had bought these puts here, these 86 strike puts. So that's their hedge here to protect this trade in case it does go the other way. And so that's something to keep in mind. And that's also what we wanted to do when we constructed our trade. However, we didn't want to put in 9,000 buying power by selling these puts. So what we did instead was we sold the 80 strike puts, and then we bought the 80 strike puts for a further date, which is in 32 days on May 19, and created a calendar spread, right? And then we also did that 90 strike puts. We also sold that, and also bought the 88 strike puts to create a bull put spread there. And so then when you look at our trade, it also looks quite similar. You see here that it also profits as the price goes up, right? Above the zero line is profit and below is loss. And there is you'll see that if the price starts to go down, it doesn't slope as significantly as and until a certain level, unless it goes below 80, you see this here, it starts to slope more than here because we have a risk reduction with the calendar spread. Part of this trade has a calendar spread here. And so we're actually collecting, if you do this trade, you can collect 15 credit immediately. And if we look at the Greeks, you'll see here it has a slight negative theta trade. Let's open, yeah. And then we have a positive Vega and a bullish 88 delta. For the other trade, on the unusual options, it is also a negative theta trade and positive Vega and bullish delta. So what we wanted to do was mimic this trade, but with less buying power. And that's what we did. Okay, so hopefully this was helpful and you learned something. If you did, please smash the like button, and it'll help us make more of these videos as we analyze these unusual options to figure out what these large institutions are doing and what they expect and how they are hedging their bets as they put on these very interesting trades. Okay, all right, take care everybody and good luck.